the financial statements analysis. So basically here we shall be talking about the ratios. Let me run a Word document here. Let me share these. So these notes are in your LMS. These notes are in your LMS, the financial statements analysis and interpretation, or about ratios. So we have got the specific objectives of financial statements analysis. Why do we need to do an analysis? Number one, to assess the past, present, and future performance of a business organization. To assess the past, present, and future performance of an organization or enterprise. That is an analysis. Number two, assess the operational efficiency of the firm as a whole or its various divisions or departments. The operational efficiency here is on how are we utilizing our assets in generating revenue. The other one is assess the performance of one firm against another or industry as a whole, and therefore you can be able to do the performance evaluation of one division against the other. So inter-industry or inter-firm analysis. Assist in developing of forecasts and preparation of budgets. You can be able to know the trend the business is making, either we are expanding, so that you can be able to do a very accurate forecast on what might be happening in the future. The other one is assess the financial stability of the business and a review and assist in the understanding of the real meaning and significance of financial information. When you are given the financial statements, you might not get much information from it or much understanding from it until now you look at the financial analysis part of it. So the ratios I'm going to give you, we have got this classification of ratios, profitability ratios, liquidity ratios, efficiency ratios, capital structure, and the investment ratios. We are going to talk about the first four. Those are the ones that you are going to be tested on. The profitability ratios, they measure the performance of the business in terms of profit. How much profit are we generating versus what our competitors are generating, or versus what we used to generate in the previous years. Then we can be able to know the progress the business is making. So we are going to look at the commonly used profitability ratios. One, we have the return on capital employed, normally known as the ROCE. I'm going to give you those ratios on the board. So the profitability ratio is actually an analysis of the business in terms of profit. The ROCE, the net profit margin, the gross profit margin, the return on equity, and the others. Then we have got those ratios we call the liquidity ratios. The liquidity ratios, they measure the ability of the firm to pay short-term liabilities. The ability of the firm to pay short-term liabilities. Those liabilities within a financial year, are we able to pay them when they fall due? If we are able, then the business is liquid. If we are unable, then we are not liquid. And you need to note that short-term liabilities are the current liabilities. Therefore, they should be paid using the current assets. So if our current assets are more than the current liabilities, our liquidity position is going to be okay. We are going to use these two methods or two formulas to calculate the liquidity, the current ratio, current assets over current liabilities, and the quick ratio, also known as the acid test ratio. So that is where we are heading, understanding these formulas and knowing how to apply them. Then we have the activity ratios, also known as the turnover ratios, efficiency ratios, or asset usage ratios. These ratios, they actually measure how well the business organization is using the available assets in generating revenue. How well are we using the available resources or assets to generate revenue? So we have quite a number of them in that list. And we are going then, after the efficiency ratios, we are going to look at the leverage ratios or the gearing ratios or the capital structure ratios. These are the ratios that measure the proportion of capital that is owned by the owners, that is equity, versus the capital that is borrowed. The borrowed capital is what we call what? The debts financing. So how much is financed by debts and how much is financed through the owner's equity? So you need to understand that when we have got a lot of debts, they are going to be a burden to the business. Like, for example, the debenture interest. If you raise your capital through the debenture, yes, it's okay. But remember, each and every year you will be paying the debenture interest. That debenture interest, it is an expense. And actually, it is mandatory for you to pay them. If you don't pay or you are unable to pay because the business did not generate enough profit, legal action will be taken on your business. So you need to have a very good balance of debt and equity financing so that the business is not overburdened by a lot of debts. So we have got the types of ratios that are going to measure the leverage or the capital structure under that, and that will be the end. We are not going to go to these different covers and all that. The other thing now, maybe you can have an understanding on is the importance of ratio analysis. Number one, it is going to measure the ability of the firm to measure short-term financial obligations, and that is what we call the liquidity. Number two, it measures the extent to which the firm uses its assets to generate sales and profit. Those are going to be the activity ratios that will measure that. It helps to measure the extent to which the firm is financed by non-owner fund, the debt, that is the leverage ratios. It compares the firm performance with other firms in the same industry, the cross-sectional or inter-firm analysis, and therefore you can be able to position yourself in the market. Compare the firm's performance over a period of time, that is intra-firm comparison. When you are comparing between yourself, that is the current performance and the previous performance, also helps in formulating future financial policies and helps in effective cost control. Even if ratio analysis is very, very good and very okay, it suffers some limitations. It suffers some limitations. Number one, remember, we normally compute the ratios using the data that we have reported ourselves. If that data is incorrect, then we are going to calculate ratios on incorrect data, and then we are going to make actually wrong decisions at the end of the day. So ratios, they are going to be accurate only if the accounting data is accurate itself. If it is not accurate, then it is going to be misleading. The other one is price level changes. Price changes over time, and this one makes impossible or hard to do analysis or comparison between firms. Like, for example, if you are doing intra-year comparison, and then the previous year, the price was very low. This year, the price has gone very high. It becomes very hard to do a comparison on the performance. It ignores qualitative factors. Accounting ratios, they only use the quantitative data, figures that can be expressed numerically. If a particular aspect cannot be expressed numerically, however important it is, it cannot be used in computing the ratio. So it is biased. It ignores the qualitative factors. The other one, it is going to be using historical data. Historical data, it simply means that data from the previous years, and you might find that what happened previously might now be outdated. We cannot base that particular information when it comes to decision making. That information might not be useful in the current situation because the information is outdated. The other one is different accounting policies. Different business organizations, they have different accounting policies, which might make it hard for us to do comparison. The other thing is difficult to decide on the proper basis of comparison, use of accounting methods, whereby maybe depreciation, we are using straight line method. The other firm, it is using reducing balance method. It becomes a bit challenging because of these different accounting methods. Ratios are insufficient in themselves, meaning that even if we have got good ratios, at the end of the day, they must be interpreted and actually implemented by a human being. So some of the managers might ignore the use of the ratios, even if there is very important signals that they are supposed to incorporate. And when they are used in isolation, they become useless, among others. So on the theory part, just understand the limitations of ratios, the importance of the ratios, and the objectives of the ratios. But the most important part of all those is to understand how do you compute different ratios. How do you compute different ratios? So you need to understand several formulas which will assist you in doing the computation. So let me see. Now we shall go direct to somebody is being asked to put off the video. Yes, thank you. So we start with the profitability ratios. We have said, or we have said that these are ratios that are used to measure the profitability position of the business over a period of time. And these ratios, they are, if you are able to master these ratios, then you will be okay. One, it is the return capital employed. Return on capital employed, the ROCE, which is given by net profit over capital employed times 100%. The good thing about ratios, they will prepare the financial statements for you. You will be given a summarized financial statement, and then now your work is to pick the figures from that statement and apply them in the formula. Everything will be done for you. Just take the figures from the statement that they have already prepared for you. You press them in the formula, compute that. You get that. So capital employed, is given by the fixed assets plus current assets minus current liabilities. Capital employed. So in simple terms, or we can simply say it is given by total assets minus current liabilities. When you add fixed asset plus current assets, you get total assets. Then you have the current liabilities, you will get the capital employed. You will get the capital employed, which you shall use here as the denominator. That is the first one. Number two, ratio under the profitability. It is the net profit margin. Net profit margin, which is given by net profit divided by sales times 100%. Net profit over sales times 100%. Those figures you will be given. You only need to remember the formula, then you go and find those figures in the statement that will be given. Number three, it is the gross profit margin, which is given by the gross profit divided by sales times 100%. Gross profit divided by sales times 100%, you will get your gross profit margin. Number four, it is what we refer as the return on assets. For that, we have the return on equity. Also known as the return on investment. Return on investment, ROI. ROI. It is given by profit attributable to ordinary shareholders divided by profit attributable to ordinary shareholders, divide by equity. Divide by equity. Then you multiply by 100% here. Number 5 is return on assets. Return on assets, which is given by net profit divided by average assets. Net profit divided by average assets. Average assets is given by assets for the current year plus assets for previous year then you divide by 2. Then you divide by 2. You sum the assets for the current year plus assets for the previous year. Then you divide by 2. You get the average assets. And actually, that is the figure that you are going to use there. Those are the profitability ratios that we have. We shall use them in solving some few examples. Don't worry, we shall apply them. Then we go to the ratios we call liquidity ratios. Category 2, liquidity ratios. A, we have got the current ratio, which you take the values of all the current assets. You divide by the value of all the current liabilities. Current assets over current liabilities gives you the current ratio. Another way you can measure the liquidity of the business is by doing the quick ratio, or also known as the acid test ratio. It is a modification of the first one. Take the current assets, deduct inventory from that, then you divide by the current liabilities. Then you divide by the current liabilities. You will get the quick ratio. So that ratio simply says that even if inventory is a current asset, in most cases, inventory behaves in a manner that we cannot categorize it in as a current liability. Sorry, it behaves in a manner that we cannot categorize it as a current asset. Why? Because the definition of a current asset there are those resources that are going to be in the business for shorter period of time, less than a financial year. But some inventory items, not all of them, they can stay in the business for more than a financial year. They can stay in a business for more than a financial year. And the moment they exceed a financial year, then they violate that particular rule of current assets. Current assets are those assets that are in the business for less than a financial year. It is possible for you to have some inventory items that will be in the business for even 3 years without being sold. Are they still current? No, they are not current assets if they are beyond. So we normally deduct the value of inventory from the current assets so that we can remain with the true and correct current assets in any business organization. Then we divide by the current liabilities. Those two will be our liquidity ratios. Number 3, we have the activity or the turnover or efficiency or asset usage. Ratios. These are ratios that measure how well we are using our assets in generating revenue. How well are we using our assets in generating revenue? The revenue that we raise or we realize compared to the assets we have, do they commensurate each other? Or a lot of our assets are just idle and they don't generate revenue? So one of them here is the rate of stock. Stock is also known as inventory turnover, which is given by the cost of sales over average stock or inventory. Stock is the same as inventory. So average inventory is given by the opening inventory plus the closing inventory. Then you divide by 2. Average inventory is the opening inventory plus the closing inventory. You divide by 2. It gives you the average inventory. Then after getting the average inventory, that figure you divide by the cost of sales. Cost of sales, remember the song? Opening stock plus purchases minus closing stock. That figure we divide by the average inventory. Here we have the stock or inventory conversion period. Stock or inventory conversion period, which is given by the number of days, or weeks or months the business operates in a year, divide by the inventory turnover. The rate of inventory turnover, which we have calculated as A there. C, we have the debtors, stock, accounts receivable, turnover. Remember, if I can come back here, the rate of stock turnover, it shows the number of times we are converting our stock into sales, or the number of times we are replacing our inventory. The more the number of times, the better the performance. So it is the rate at which we are buying stock and selling. So if we are frequently buying and selling, then the business has got good sales. and the business is doing well. But when the turnover is low, then it simply means that we have a lot of dead stock. Items are bought and then they stay a long period of time before they are converted into sales. The debtors or accounts receivables turnover, it measures how we are actually going to collect money from our debtors or our debtors. So here we calculate it by this. The credit sales or simply sales over debtors. Don't forget debtors are the same as the accounts receivables. Sales over the debtors or accounts receivables. B, it is the debtors stroke accounts receivable. Correction period. Debtors or accounts receivable collection period. You change this, do the reciprocal of this, now it becomes to debtors over credit sales. But here now you multiply by the number of days or weeks or months the business operates in a financial period. This one is credit sales over debtors. This one becomes debtors over credit sales, but because it's correction period, you multiply by the number of days or weeks or the months. That one will be provided in the question. If it is not provided, you take a year to be having 365 days. Multiply by 365, but you will be provided with that information. We are not yet done with the turnover ratios. We have the creditors, also known as the accounts payable. Turnover. The creditors or accounts payable turnover, which is given by the credit purchases or simply purchases over the creditors or the accounts payables, like that. Credit purchases. If the question does not give you credit purchases, but it gives you purchases, just use that figure, divide by the creditors, you get the accounts payable over. That is E. F. Creditors or accounts payable payment period. For the debtors, it is collection period, but this one is payment period because creditors, we are supposed to pay them. So it measures the duration we take to pay the creditors. So here we are going to reverse this or to do the reciprocal by doing creditors over credit purchases times the number of days or weeks or months in a financial year. The duration we are taking to pay our creditors. The duration we are taking to collect money from our debtors. This one, the shorter the period, the better. The debtors collection period. If we can be able to collect that money from our debtors as soon as possible, the better. But for this payment period, the more the days we take, the better, because they are going to give us a lot of time to use that money to generate more revenue. So the longer the duration, the better for this. But this one, the shorter, the better. This one you are paying, this one you are collecting or receiving. Then we have
Sorry, Mwalimu, just repeat that. So if the days are more on the creditor's account payable period, is it better or
it is better for the business?
Better, the more.
Yes, when there are more, You know, when you are given more days to pay, that person is giving you a lot of time for you to the money that you have paid that person, you can use it to generate more income. So the more the days, the better when you are paying. But when you are collecting, the shorter, the better.
Okay, understood.
Yes. We have the fixed assets turnover. Which is given by sales of a fixed assets. H, current assets turnover will be given by sales of a current assets. Current assets turnover, sales of a current asset. Then we have what we call the total assets, which will be given by sales of a total asset. Total assets is the sum of current and fixed assets. Current assets plus fixed assets, they give us total assets. Average total assets equals to total assets for current period plus total assets for previous period and you divide it by 2. Total assets for the current period plus total assets for the previous period, you divide by 2, they will give you the average total assets. We are done with the activity ratios or turnover ratios. The last category of ratios, number 3 or 4. We started with profitability, liquidity,
number 4.
Turnover, and this is number 4. We call them the leverage or the gearing or what we call the capital structure. Ratios. Those ratios that show the composition of our capital. How much of our capital is debt financed and how much is equity financed. The gearing or the capital structure ratios. These ratios are number 1, the gearing ratio, also known as the debt to equity ratio. Debt to equity ratio given by fixed return equity. Then to this, you divide by equity capital. So when we talk about fixed return equity, those are the borrowings that normally attract fixed interest annually, like the debentures. We have remember debenture comes with a percentage, like 10% debenture. It has a fixed return of 10% every year. 12% preference shares, same. Maybe 10% bank loan, same. They have fixed return. And this actually, they normally have that percentage before as they are suffix or prefix, like 10% debenture, 10% preference shares, 15% bank loan. All those have got fixed return kind of interest. So we add all of them, like the debenture plus the preference plus the bank loan. We add all of them to get the fixed return equity for that business. This is A. B is the debt ratio given by total liabilities divided by total assets. Total liabilities is simply current liabilities plus the long-term liabilities. You add them, then you divide by the total assets. Fixed assets plus current assets. Then we have the equity ratio. The equity ratio, which is given by equity divided by capital employed. Remember, capital employed, it is simply total assets, fixed assets plus current assets, you minus current liabilities, gives you the capital employed. Equity, it is the ordinary share capital plus all the reserves, the general reserve, the retained earnings, the share premium reserve, and the revaluation reserve. In the reserve, we add it there to get the equity plus the ordinary share capital. E, we have got the time interest, also known as the interest coverage. Interest coverage. Time interest or the interest coverage ratio given by net profit before deducting interest and tax divided by interest expense. So those are the formulas that we shall use in doing the ratio analysis. The formulas that we shall use in doing ratio analysis.
Mwalimu, just explain more on that formula, the one for interest. What's the interest expense?
Interest expense? Huh?
Yes.
What is the interest expense? The interest
what
expense,
is interest?
like, for example, when we did the debenture interest, the
10%.
The 10%, that is the debenture interest. That is the interest expense.
Okay.
It can be the interest on bank loan. Maybe it is a certain percentage of the loan that we borrowed. So that expense that comes as a result of the loan that we borrowed, it is the interest
So
expense.
if you have a couple of them, like, I don't know, like you have now that like a loan interest, and then you have debenture interest. So you sum them up, or how do you get?
Yes, you sum them up. Huh? You sum them up. If you have the loan interest, the debenture interest, you add them so that now you can get the total interest expense, which we use in that particular formula. Okay. Now from there, see to chape kazi. We look at questions. I had shared with you some past paper question on the same. Ratio analysis class discussion questions. So I have resent the document for those who have not found it. So let us look at what we have. So we have this document. The June 2017 question 4. It asked, the following information was extracted from the final accounts of Sahara Limited and Karhali Limited for the year ended 30th September 2015. So we are given those statements like that. The good thing about the ratio analysis, you will be given the statements. Your work is just to remember the formula and fix the figures in your formula. So in this case, you are given a summarized income statement and a summarized balance sheet. The balance sheet is the same as the statement of financial position. And then for the 2 years, for the two companies, Sahara and Karahali. Now you are required to compute those ratios that you are told there. The acid test ratio.
Molima, will you be allowed to go in the exam room with a summary of the ratios? These are 22 ratios. We're supposed to memorize all of them.
You cannot go to an exam room with any written material.
Sasa mwalimu, hii ni ngumu.
You cannot have the summary. You cannot go with your written materials. You just carry your pen and your calculator and you are good to go. Sasa lazima uzielewe. For each of the company, compute the following ratios. Let us go and see how those ratios are going to be computed. One, just remember the formula. Ukisha remember the formula, then it becomes easy. One, you are told to do the acid test ratio. Acid test ratio. Remember, this is the same as the quick ratio. The quick ratio. Very simple. The formula is current assets. You deduct inventory. Then you divide by the current liabilities. That is our formula. Then we need to calculate now for Sahara. What will be the acid test ratio for Sahara? We just go to the Sahara and pick the current assets. For Sahara, what is the total for the current assets? Huh? And at this point, I want to believe you know what qualifies to be called the current assets. So we are given there current assets, column, inventory, debtors, cash at bank. Those three are current. Inventory, debtors, and cash at bank. So we need to add the three of them. So for inventory, it is 100,000 for Sahara. You add 46,000. I think that is 46,000. Then we add 40,000. We get 186,000. That is current asset. From this figure, subtract the figure for inventory. Inventory is 100,000. Then you divide by current liabilities. Current liabilities, you are told there current liabilities, you are given a figure, 98,000. That one will be equal to 86,000 divided by 98,000, which gives us a ratio of what? 86 divided by 96,000 gives us a ratio of 0.89, which is almost 0.90. We express that. That is, now you put it in ratio form, is to 1. Is to 1. 0.9 is to 1. It is a ratio. It's a ratio. It's to 1. Then you will proceed and do the same for Kalahari. Current assets for Kalahari. For inventory, it was. Yes.
Before you move to the next one,
Yes.
why are we putting is to 1 instead of 9 is to 10?
Why?
I don't know. Why are we putting the ratio as 0.90 is to 1?
Ratio, it is normally written in form of A is to B, yeah?
Yes. Yes.
Now, this is now the answer for this. We normally compare it with 1. Normally compare it with 1 when both of them are equal. If the numerator part is equal to the denominator, so tutapata 1. So
Yes.
we normally write it is to 1. Don't put it to any number. Put it always is to 1. That is
Okay.
when it is a ratio.
Mwalimu, you are rounding off the numbers.
Yes,
Like
I've rounded. I was to round it off to do decimal places. If you look at the figure that I got there, it was 0.895. That 5 ukileta ama nini inafanya zinakuwa 9. So I have rounded off the figures. In short, I've rounded off the figure.
So we should be rounding off to
Yes,
maybe 1 decimal point
or two. Just count 2 decimal places.
Okay.
Yes. Correct. If you go now to Kalahari, you need to pick the current assets. You deduct the inventory for Kalahari, you divide by the current liabilities for Kalahari. The next column, the current assets, inventory for Kalahari is 87,000. You add to debtors, 42,000. You add to cash at bank, 44,000. You get 173,000. You deduct inventory, which was 87,000. Then you divide by current liabilities. For Kalahari, it is giving us 108,000. So what do you get? 173 minus 87,000. 86,000. divided by 108,000. You get 0.79, but if you round it off, itakuwa ni 0.80. Is 1. That is done for acid test ratio. Number B, column 2, it was asking us to determine inventory turnover. Inventory turnover, which we know is given by cost of sales divided by average stock or average inventory. Divided by the average inventory. For Sahara, the cost of sales is given in the income statement, 258,000. Divided by average inventory. For Sahara, we are given inventory is what? 100,000. So you divide it by 2. You divide it by 2 because we are not given opening and closing. Divided by 2. We are simply use divide by 2. So the inventory for Sahara was 100,000 divided by 2. That one would be the same as what? 50,000. This one is going to be equal to what? Sorry. Let me put here 100,000 divided by 2. That is where we get the average inventory. Yeah? So this one is the same as 258,000 over 50,000. How many times are we buying inventory and selling it? Divided by 50,000.
5 times.
5 times. Approximately 5 times. You write there times. Turnover is always in terms of times. Kalahari. You round it off this one to the nearest whole number. The cost of sales for Kalahari, it is 153,000. $153,000 divided by the average inventory. Inventory for Kalahari was 87,000. Do 87,000.
Wait.
Somebody should mute. So for Kalahari, the inventory was 87,000. The average of which we divided by 2. This one is going to be equal 153,000 divided by 87,000 divided by 2. You get 43,500. What do you get?
It comes to about 3.5.
Huh?
It comes to about 3.5.
3.5 times. Huh?
Yeah.
Let's say approximately 4 times. The number of times we are repressing our inventory in the business. Then we have the third one is average collection period. It is the same as the debtors correction period. The same as the debtors correction period, which is given by the debtors or accounts receivables divided by sales times the number of days. I told you the number of days on which are not provided, use 365 days, which is the known number of days in a year. So in this case, for Sahara, that is the debtors or accounts receivables, 46,000, divided by the sales up there, 497,000. Then the days are not given, multiplied by 365. $497,000. You get approximately, let us use the approximately 33, approximately 34. Let us use actually the decimals here. We take an average of those number of days to correct money from our debtors, 33 days. Kalahari. The debtors for Kalahari, 42,000, divided by the sales for Kalahari, 371,000 times 365. For 1.3 days. The other one is the ROCE, return on capital employed. Given by the net profit. It's also the operating profit. All over capital employed times 100%. Right, by capital employed times 100%. Sahara. The operating profit or the net profit, 138,000. Capital employed, we said it is the total assets minus current liabilities. Capital employed is the total assets minus current liabilities. So the total assets we shall have the non-current plus the current, 142,000, which is for the fixed assets, plus all the current assets that we have, 100,000 plus 42, 46 rather, plus 40. I hope you can be able to understand where I'm getting those figures. The total assets, we have the non-current assets there, 142,000 for Sahara. The current assets are inventory, 100,000, 46,000 debtors, and cash at bank, 40. Those are the current assets. So they are giving us a total of 186,000. Then this one, we minus the current liability, which is the current liabilities are 98,000. So this one will give us 138,000 divided by, that we do the computation, 186 plus 142.
Mwalimu, question, why aren't we adding another current liabilities? Why aren't we adding the long-term loan?
Sorry?
Oh, okay, understood.
Okay. If you have understood, good. Minus 98,000. Sorry.
88,000.
88,000. Then whatever we get here, we multiply by 100,000. So that one will give us what?
Wait, 142 plus 186 minus 98 cannot be 88,000.
Yes, it's 230.
Oh.
230,000.
The total is to that?
Yes.
230,000. Yeah? Okay. Yeah, it sounds correct that way. So 138 divided by 230. I'm getting 0.6 times 100. 60%. That is the return on capital employed, the rules. You take the operating profit, which was for Kalahari, the operating profit up there is 79,000. We divide by what? Total assets minus current liabilities to get capital employed. The non-current assets are 92,000 plus the current assets 87 plus 42 plus 44, 173,000. Then we deduct the current liabilities, 108,000. Then whatever we get, we multiply by 100%. 79,000. 92 plus 173. Minus 108. 157,000. We get 0.5. Debt equity ratio. That is the leverage ratio, or it is one of the gearing ratios that we have, the debt equity ratio. which we said it is the fixed return capital over equity capital. Right, the formula first. Fixed return capital divided by equity capital or equity. For Sahara,
Mwalimu,
Yes.
where is that? Where are you getting that formula from? Because if I go back to it, these ones are under the leveraging capital structure ratios, right?
yes,
There are two that you have put there. Oh, okay, I get it. So if this is the gearing ratio.
yes, the gearing. Gearing ratio is the same as the debt equity. Yeah?
Okay, understood.
This is the gearing. The gearing ratio. So in this case, the fixed capital here is actually the long-term loan. The long-term loan for Sahara, the long-term loan is what? 33,000. The equity is what is captured there as shareholders' fund. What belongs to the shareholders? 197,000. The shareholders' fund is the equity. That 3 divided by 197. 0.18. 0.18. What about for Kalahari?
Mwalimu, if you round off, you're getting 0.18.
17.
When I'm getting, yes, 17.
Correct. 17.
Can we round off this one or we don't round off?
Which one? You round off to 0.17.
No, I'm saying you can't you put it 0.2.
2 decimals are better.
Okay.
2 decimals are better.
Mwalimu, then do we put the is to 1 or we just leave
No.
that? Leave it that.
This one we don't. Actually, it is only the liquidity ratios. The current
Okay.
ratio and the other ones are the ones that we put it on.
Okay.
Then for Kalahari, they don't have long-term loan. It is given as a dash there. So they don't have debt to equity ratio because they don't have any debt. They don't have any debt. They don't have any debt. So that ratio cannot be computed. So this is simply a dash. Can't compute that because there's no any debt. So to stop there.
Mwalimu, and what if you put 0?
0 and the dash, do we have, is there any difference? I believe no.
No, okay. So you can put, okay.
There's no difference. 0 means none, dash means none.
Yes.
Now, I want you to compute the others. Now that you have the formulas and I have shown you how to do it, a good try is zingine. Just insert the formula, then you compute. Like for this one, you are only told for the year 2017, so you only concentrate on the figures on the 2017 column. You don't need to do for 2016. So just use the formulas, all the formulas you have, and then you can be able to compute that. Then in our next classes, you'll tell me if you have any challenge. And up to that point, I can say we stop it there. I think I've done it from 2 p.m. I think I feel exhausted.
Even us mwalimu tumechoka.
So
Thank you very much.
we meet tomorrow for the old curriculum. And I told you now, I don't need you for Sundays. I only need those for those who are doing the new curriculum. Sisi tuko na mwendo bado. For the old curriculum now, you are sorted.
Mwalimu,
We
just a
appreciate
question
mwalimu.
for the new curriculum, Mwalimu.
Yes.
Just a question. Do we still have a long way to go in that by the time, because I saw it's the first exams on my timetable, that is 14th June, will we be able to give time for revisions?
Now,
Will we be able to cover the syllabus and allow time for revision? That's my question.
I don't know how I'm going to respond to that, but it is tricky.
From your prediction, I'm
It's
sorry I'm
tricky.
putting you in a tight spot, but are we able to do what is